Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Friday, November 21st, 2025, and we've got a packed show for you.
That's right, Ethan. We've spent the night sifting through a mountain of data from Thursday, November 20th. Today's analysis flagged quite a few different stocks across social media, with a substantial number of posts indicating some very strong and, in some cases, wildly optimistic sentiments out there.
Definitely. It feels like the market's got a bit of a split personality right now. Some genuine excitement for growth, but also plenty of caution lurking beneath the surface. We're seeing a really interesting mix of promising developments and some, shall we say, rather risky situations.
Indeed. Let's dive right into our first lead, New Fortress Energy, or NFE. The AI-generated insights show some users are extremely bullish, with talk of fast LNG ships, a Brazil deal locked, and even a price target of 50 plus. They're practically chanting to the moon.
And that's the kind of energy, that really catches an investor's eye. People are seeing these big infrastructure projects, the potential for massive growth in the LNG sector. It's all about looking forward to that next big wave. Last time we talked about NFE, it was a speculative gamble just a couple of days ago, and before that, a stay away. This sentiment definitely signals a shift in perception for some.
Hold on a minute, Ethan. While the user sentiment is high, the underlying data tells a very different story. NFE's current price is just $1.46 compared to a 52-week high of $16.66. That's a over 90% drop. Not exactly to the moon, is it? Plus, their financials are grim. Negative revenue growth, negative net profit margin, negative EPS, and a truly alarming debt-to-equity ratio of over 675.
Ouch.
And it gets worse. The company just signed a forbearance agreement on their 2029 notes. That's a big red flag, indicating significant financial distress. It means they're struggling to meet debt obligations. Given the negative financial performance in recent news, it really overshadows any future potential those fast LNG ships might offer. So, for NFE, our market commentary is a strong stay away. This is a downgrade from its previous speculative gamble rating.
All right, noted. Next up, let's talk about Walmart, WMT. Now, this is a story that brings some real optimism. The buzz is all about their Q3 2026 earnings beat, raising their full-year outlook. We're seeing strong e-commerce and international growth. Analysts are bumping up their price targets. Wells Fargo to 120, Truist to 119. That sounds like a company firing on all cylinders, wouldn't he say?
It absolutely does, Ethan. The latest news is overwhelmingly positive, and the KPIs largely support a bullish outlook. Their current price at 107.11 is very close to its 52-week high of 109.58, showing strong recent momentum. A robust return on equity of 23.38% tells us they're managing shareholder capital efficiently.
See, that's what I like to hear. A company that delivers on its promises and shows consistent growth. The previous rating for WMT was a stay away back in October, but we upgraded it to a buy just yesterday, based on earlier reports. Looks like that was a good call.
It was. However, it's worth noting the PE and price-to-book ratios are relatively high, indicating the market already has significant expectations. And their debt-to-equity is still 68.7, which is something to keep an eye on. But yes, the earnings beat and raised guidance definitely justify the current market enthusiasm and could lead to continued improved revenue growth. Based on these strong fundamentals and market reaction, for WMT, our market commentary is a buy.
All right, from a powerhouse like Walmart to, well, SGBX, or Safe and Green Holdings Corp. The social media chatter around this one is pretty brutal, with users calling it a dried-up fruit corp and telling people to dump that rotten core. Not exactly confidence-inspiring, Brooke.
You're right, Ethan. The sentiment is overwhelmingly bearish, hitting a -9 on our sentiment score. While some might point to future plans for their Olinox energy subsidiary, like aggressive drilling and AI implementation in 2026, the current reality is very different.
Well, even with that gloomy user outlook, sometimes those are the ones where you find a turnaround play. But it sounds like the numbers are not on its side this time. SGBX has never been rated on our podcast before.
Not at all. The current price of $3.82 is a staggering 96% down from its 52-week high of $122.88. They have negative revenue growth and an earnings per share of negative $153.79. Deeply negative. There's just no way to justify a buy here. The current initiatives, while forward-looking, are not translating to financial health right now. SGBX is a clear stay away.
Okay, let's move on to MSTR, Strategy Inc. We're seeing some dip buying attempts, suggesting some users believe it's oversold. There's that underlying connection to Bitcoin, which always brings a certain level of speculative excitement for growth.
Ethan, that dip buying is being openly mocked by the community. Comments like, "Yeah, you're screwed, LOL," and "ha ha ha" are telling. MSTR's current price is $177.13, alarmingly close to its 52-week low of $171.47, a drastic fall from its 52-week high of $457.22. It's been a stay away for us many times, going all the way back to October.
You can't deny the strong community reaction, but for every mocker, there's usually someone thinking they're smarter than the crowd, right?
Perhaps, but the data is pretty damning. We're talking an extremely high debt-to-equity ratio of 14.47 and a beta of 3.374, meaning it's incredibly volatile. And the news, JP Morgan is warning that MSTR could be excluded from major stock indices like MSC. That would force institutional selling and could send the stock spiraling further. This speculation about its future means it's still a stay away.
Right. Next up, Bull, or Webull Corporation. This one feels like a fascinating turning point. While some users are expressing frustration from past losses, plus 15 leaps are now down 18K, there's a real undercurrent of optimism. Many are calling it a deep value play and a screaming buy below 9. And the big news, Webull's Q3 reportedly swung to profit with rising revenue. That's a huge shift from previous ratings, which were mostly stay away or speculative gamble.
That's the key, Ethan. The news of a Q3 swing to profit is a major catalyst, and it directly contradicts their historical negative profit margin and ROE. Their revenue growth is also strong at 44.7%. If this is sustained, it absolutely has the potential to transform their KPIs. The current price of $8.25, near its 52-week low of $7.99, makes that deep value argument compelling.
Exactly. It sounds like the company is really finding its footing and the market's starting to take notice. It's exciting to see a potential turnaround story.
It is, but let's temper that excitement with a dose of caution. While that Q3 profit is fantastic, it's just one quarter. They still have a very high debt-to-equity ratio of 15.05 and a PE of almost 55, which is high even for a growth company. Sustained profitability will be crucial to manage that debt and justify the valuation. So, while it's a significant improvement from previous ratings, for Bull, our market commentary is a cautious buy. We need to see that trend hold.
That's a fair point, Brooke. Finally, let's discuss Hood, Robinhood Markets. We saw a post titled LOD has been good to me this week, where the user made huge profit by adding puts. That suggests some active bearish trading.
It does, and the comments are full of congratulations for that bearish bet. We've had mixed ratings for Hood in the past, a couple of cautious buys, but mostly stay away or speculative gamble. The data indicates a sharp 10% decline on November 20th. While some might still look at Robinhood's strong revenue growth and profit margins, the overall sentiment is overwhelmingly bearish right now, especially with news of financial stocks trading down.
But, you know, they've got a solid platform, and their CEO has been talking about the role of AI. There's still a loyal user base.
Even with that, Ethan, the financial risks are substantial. Hood has an extremely high debt-to-equity ratio of nearly 189. Their beta is 2.423, making it incredibly volatile. And while past operational metrics are decent, the PE ratio of 44.25 suggests the stock is priced for very high growth, which the recent 10% drop, combined with overall market sentiment, indicates isn't being met. The news of them trading down alongside other financial stocks simply reinforces the negative outlook. Therefore, for Hood, our market commentary is a stay away.
All right, let's bring it all together for our listeners. Based on today's analysis, here are our top candidates for deeper investigation. Investigate as buy, Walmart Inc., WMT. Investigate as cautious buy, Webull, BUL. Investigate as speculative gamble, New Fortress Energy Inc., NFE.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Do your homework. That's all the time we have for today. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you next time.